Hello, I'm Corey Newton, and we're going to talk a little bit about constitutional capitalism and common defense this late Friday evening, early Saturday morning. And we're just going to jump right in. Article 1, Section 8 of the United States Constitution authorizes Congress of the United States to borrow money on the credit of the United States. So we're just going to jump right in and see what that looks like. Now, there's debt held by the public and debt held by government accounts. So we'll jump into debt held by the public. 48% of it is international investors, 31% of it is private investors, 15% is the Federal Reserve, 6% are state and local governments. So let's take a look at that. First we'll jump to the foreign investors. Top of the list is China, mainland, $1.2 trillion they hold in Treasury securities. Japan, $1.2 trillion. Belgium, $360 billion. Caribbean banking centers, $308. Oil exporters, $262 billion. Brazil, $253 billion. You go down the list. Taiwan, Switzerland, United Kingdom, Hong Kong, Luxembourg, Russia, Singapore, Norway, India, Mexico, Germany, Canada, France, Korea, Turkey, Thailand, Netherlands, Australia, Kazakhstan, Sweden, Philippines, Colombia, Italy, Poland, Chile, Israel, Spain, Denmark, South Africa, Vietnam, Peru, all others. Outstanding Treasury securities, $6 trillion. Now, 15% of this was held by the Federal Reserve. What do they hold? As of, what's today? 2 days ago, they held $2.4 trillion in U.S. Federal Treasury securities. So you could look at that over time. Let's look at it right before the recession here. 2007, November 14th. $779 billion. And it dropped off a little more, $491 billion. As you can see, it ticks right back up. Look at it tick up. Look at this increase. You go from, let's see, we're right about here before it takes off. Almost $800 billion to almost doubling. And then another low spot. Now look at that number. 1.6 trillion, rocking on up to 2.4. Now, Federal Reserve is buying Treasury securities as part of quantitative easing, and they're not buying them all from the federal government. Now, if you remember from here, domestic private investors hold 31% of them. So they're buying them from banks is what they're doing. They're buying them from banks and financial institutions, as well as directly from the federal government. But it's interesting that they're buying them from banks. It's interesting that during the crisis, all of a sudden, this shoots up. And then the stock market shoots up right along with it. Very interesting. Can, draw your own conclusions from that. Okay, here we go. This is, as of August, last month, debt held by the public. Again, here's debt held by the public. Now, at the end of 2012, it was $11.3 trillion. At the end of August 2014, it's kicking out right about $13 trillion. $13 trillion. Now, look at the interest. The green is the interest. So this is held by the public and the Social Security trust funds. We'll go review those quickly. Okay, Social Security trust fund, 57% of the debt. Civil service and retirement, 17%. Military retirement and healthcare, 12%. Moving on to other programs and trust funds, 8%. Medicare trust fund, 6%. Now let's head back. Here it is. So this is all your trust funds we just mentioned. This is the interest. That's the interest on it. Here's the interest on this. So this raises a question why they keep interest rates so low artificially through QE and this bond buying program. Because look at the amount of interest on the debt. So that should raise some questions in your mind. Here's a monthly statement of the public debt of the United States, August 31st, 2014. So marketable, non-marketable, 17.7 trillion. And here's your debt held by the public, intergovernmental holdings, which we already went over. So this is the difference between the two. Oops. And this is the difference between the two, which you see here in the bar chart. Okay, so $17 trillion. The Congress of the United States has the authority to borrow money on the credit of the United States. Is this level necessary and proper? What did George Washington have to say? I draw on George a lot from his speech, his farewell address of 1796. So let's just briefly say what Washington what kind of advice he had. As a very important source of strength and security, cherish public credit, not ungenerously throwing upon posterity the burden which we ourselves ought to bear. But it is necessary that public opinion should cooperate, that towards the payment of debts there must be revenue, that to have revenue there must be taxes, that no taxes can be devised which are not more or less inconvenient and unpleasant. 1796, he understood taxes were inconvenient and unpleasant. They just fought a war over taxes that were inconvenient and unpleasant. So before we jump on, let's head back, because there's a significant note about social insurance. So Social Security, government service, and Medicare. Okay, in here I talk a lot about public goods and services and how social insurance is not constitutionally authorized. Now, you look at the 10th Amendment. 10th Amendment says that anything not specifically delegated to the federal government and not specifically prohibited from the states belongs to the states and the people. So how do we end up with social insurance being paid for at the federal level? Well, I'll tell you how. Down in Washington, D.C., they have little constitutional origami parties. Okay? They fold the necessary and proper clause to the 16th Amendment and to the Commerce Clause, and they wrap it up in red tape, and they throw it back at us like a hand grenade that's packed with debt, and it's going to blow off, just like a debt grenade, because that's exactly what they're doing to us. So there has to be a way to reduce the liability of the social insurance programs going forward, with all the baby boomers retiring and all this. Now, I'm probably going to have to start a think tank to specifically nail down the details of this and the next thing I'm going to talk about. But my general thumbnail sketch idea is they need to reduce the liabilities of these programs going forward. So a proposal that I have in the preliminary stages of working on is the following. To reduce the liability, you need to pass a law that lets everybody who chooses to opt out of the program. And then, all right, well, we paid all this money in. Why are we going to opt out? Well, this is a reason why. Because if you opt out from the program, two things will happen. One, you're going to continue to pay for the people who stay on. But number two, you're going to get a tax credit for everything you paid in. So if you've worked however long, you have X amount in, you will get a tax credit for that money back over, depending on the amount, you could take it over 1 year or you could take it over multiple years. So you will continue to pay in to the system, but the money that you paid in over your lifetime that you choose to opt out, you get back. So you get to keep. So you can save that money, you can invest that money, or you can spend that money, or you can donate that money. And that's going to be a shot in the arm for the economy. The more people who opt out will lower the liability, and they'll have more income to spend that'll increase the economy. So that's one idea. So now, moving away from social insurance, what is the debt again? Let's go back to this one. 17.7 trillion. What do we have in gold? That's an interesting question. What do we have in gold? Well, there's an answer to that too. Gold bullion. You're looking at $10 trillion worth. It gives you a breakdown, how much they have stored. They have Denver, Colorado, has almost $2 trillion. Fort Knox has a little 6.2 trillion. West Point, 45 minutes from here, 2.2 trillion. So you break it all down, all the way down. New York Federal Reserve Bank, you're looking at all their gold, everybody's gold. So you have $11 trillion in gold in the United States. We need to, at some point, seriously consider anchoring our currency in gold. And this is another one I'm going to have to find a think tank to work out all the details and all the specifics. But at some point, we need to pay off all our debts, all the Treasury securities, and as many Federal Reserve notes as we can. And then we need to shift to a currency anchored in gold. And a lot of people are going to argue, well, it's only 11 trillion. It's not going to back, everything that's out there. Well, that's at the price that is at today. It was around $1,500 an ounce. So there needs to be elasticity in the price of gold to support the amount of paper notes you have out. So if it's got a triple, quadruple, 10, 150, whatever it has to do, we can make it work to where it's anchored in gold, it's backed, the price of gold has to fluctuate. It's not like, oh, well, gold is just going to stay at this. No, the price of gold is going to have to increase to account for everything else that's out there. Now let's bounce to what I'm talking about as far as events this week, in the past couple of weeks. So we have another page with a whole bunch of tabs. Alright, we're talking about the BRICS. Now, this is July 29th. The BRICS meeting in mid-July, June, mobilizes resources for infrastructure and sustainable development projects and a contingent reserve arrangement to provide liquidity through currency swaps. And they set up a new bank. Okay, that's what the BRICS did. So Brazil, Russia, India, China, and South America. Now the BRICS are pissed off about the dollar being the world's reserve currency. Okay, so this guy's taking that as a threat and wants to say, oh, special drawing rights. Well, what are those? Let's basically break that down quickly. SDR, special drawing right, is a basket of currency. Today it consists of the euro, Japanese yen, pound sterling, and US dollar. So what he's saying is we need to move away from the dollar as a world's reserve currency and institute the SDR. So he's trying to prop up the IMF. And the BRICS are done with the IMF. Because let's see what happens. What are the arguments against it? There's a lot of them. Alright, let's bounce out of here. There we go. So this is a story from yesterday, or the day before. Okay, creation of a new BRICS bank, new development bank to finance infrastructure and sustainable development projects in emerging economies is a landmark achievement. Developing nations have lost faith in the current system with its strict conditions on development finance and its inability to insulate countries from financial shocks. International observers, blah, blah, blah. Creation of the new development bank will strengthen the voice of developing economies shaping the future direction of global development finance. Bretton Woods institutions such as the World Bank and IMF have long dominated the development agenda. These institutions have crafted development strategies and presented them as the only viable model for generating economic growth. The power of the World Bank lies not so much in its deep pockets as enormous research and communication capabilities it deploys to set the global development agenda. Developing countries feel that their place at the decision-making table is not proportionate to their growing economic influence. For example, although the BRICS comprise over 1/5 of the global economy, together they only wield about 11% of the votes of the IMFs. But reforms have been met with reluctance and even resistance by Western nations. This is a really good article.